What's up guys, my name's Curtis and welcome to 5 Minute Finance, where I take personal finance topics and explain them to you in 5 minutes or less. I've said it before and I'll say it many times more in the future. Time in the market always beats trying to time the market. I wanted to make a dedicated video for this topic so that I could really drive my point home. To illustrate why it's not a great idea to try to time the market, I'm referencing a video from a YouTube channel called The Money Guy Show. They do a great podcast and make really informative YouTube videos about personal finance. They're financial advisors themselves. I'm going to link the video I'm talking about in the description, and I highly recommend you go watch this just so you understand a little bit in more detail why you shouldn't time the market. If you watch the video from about the 13-minute mark to about 24 minutes, you'll understand my point a lot more. They took the average annual salary of someone back in 1980, which was $12,513, and they assumed that person was investing 25% of their income, or roughly $260 per month. They then looked at what a person's net worth would be as of September 2020 in 3 different scenarios. All 3 of these scenarios assume that the person's income never increases over their entire 40-year career. They assume that they're investing in the S&P 500 index funds and that all dividends are automatically reinvested. Scenario 1 is as follows. This person takes that $260 per month and they save it in a savings account, and they let that account build up until the market crashes. They then dump all the money that they had saved up over the course of those years into the market at the bottom of the market crash. And I believe in this study they used the biggest 5 or 6 market crashes since 1980. Once they dump all of their savings into the market at the bottom of the crash, they then continue to save up money until the next crash. So this person theoretically is the best market timer ever. They save up money and they always invest at the bottom of every big crash. Scenario 2 is exactly the same, except they assume that this person has the worst luck possible. This person saves up their money and then invests that money at the top of a market crash, right before the market goes down. So not only is their money just sitting in a savings account for many years, they're also investing at the worst possible time. Scenario 3 is the boring, easy way. This person takes the $260 per month that they have dedicated to investing, and they put it into the market every single month, no matter what the market is doing. The results of this are actually pretty shocking to me, and they probably will be to you as well. In the first scenario, where this person times the market perfectly their entire investing career, their final account value would be around $1.43 million, which is an extremely respectable amount of money. In the second scenario, where this person has the absolute worst luck possible, their ending account balance is still around $892,000. This is a good chunk of money, but it's not even close to the amount of that perfect market timer. Lastly, we have that boring, easy way, where they just invest the $260 every single month no matter what. Believe it or not, the final account value in this scenario is $1.67 million, higher than both of the first 2 scenarios. I want to reiterate that all 3 of these scenarios require the exact same amount of money to be saved over the course of the entire career. And it also assumes that this person never gets any raises over a 40-year period. The reason that the best market timer ever doesn't have a higher account balance at the end in this scenario is because while their money is sitting in a savings account, the person that actually has money invested in the market is not only gaining value from those stocks appreciating themselves, they're also gaining all of the dividends throughout the year that are automatically reinvested. So not only is it extremely difficult and basically impossible to time the market perfectly your entire life, it doesn't even beat out just consistent investing over the long haul. The one positive across all 3 of these scenarios is that even if you currently make minimum wage and you are the worst market timer ever, just getting money in the market will allow you to retire with a comfortable amount of money. And more importantly than me telling you how to invest based on these 3 scenarios would be for me to just tell you to go out and invest, period. I also want to point out that even if the market crashes tomorrow, you don't actually lose that money unless you sell all of your investments at a loss. If you hold on to your investments and let the markets recover, it's as if you never lost that money in the first place. This is why consistent investing works out over the long haul. Because even in market crashes, as long as you just hold on to your investments and don't sell them, the markets are eventually going to recover and you'll be back to where you were. If you guys enjoyed this video, it would really help me out if you gave it a thumbs up. And if you're new around here, consider subscribing and hit that notification bell for more videos in the future.